concept.
Yeah.
2 lakh crores is not small.
Yeah.
We are only 1.2 in that.
Welcome back. You're watching Big Deal and we are discussing the space of private credit. So Kapil, we were discussing what this product brings to the table, but the risk assessment part of it, because you're solving for a particular purpose and the company needs a short-term finance for a particular cause. How is the risk assessment done given that the interest rates on this are also on the higher side?
So the way we think about risk, Nisha, is that there are 3 or 4 categories, as Amit elaborated on private credit itself.
Right.
Private credit is not one composite category. So performing credit, the risk management is slightly different.
Yes.
On distress, the risk management is very different. Venture debt is extremely different.
Yes.
So I don't think we'll have time enough to discuss risk assessment in all of them.
Yes.
But what I can do is I can talk about the performing credit risk assessment and the way we think about this category.
The basic principles and
the basic principle in India is there is 2 lacunas or 2 shortcomings of India today. And the sooner the fund manager recognizes those 2 shortcomings.
Right.
Number 1 shortcoming is legal systems are evolving.
Yes.
IBC has been set in place, but it has miles to go before it will have a real teeth.
Yes.
So if you understand this, that collateral enforcement works, but works only in certain situations,
Yes.
then you will build a portfolio in a certain way. Number 1. Second is governance standards, reporting, accounting, related party transactions, middle market eco landscape. How is that evolving? It is again improving as we go along. But is it at the right top-notch standards as you would find in a developed world? It's not there. If these 2 lacunas are recognized, then you start to build a risk management strategy for Indian private credit, performing credit in a very simple way. The way, at least at True North, we think about risk management happens at 2 levels. One is individual deal picking. Second is what are you creating the constructing the portfolio for your investor.
All right. So this, you've talked about investment. What about exit opportunities and recovery part?
So I'm saying when you talk about a deal,
Yes.
deal has choosing the right company, choosing the right structure, choosing the right exit strategy, building a covenant and a collateral structure around it, which most people do, all of us do as an industry. But obviously at some point in time, you could go wrong.
Right.
It's a 16-17% product. It's a 14 to 16 to 18% product. What are your risk mitigants? The way we think about risk mitigant is obviously you do the work, which is what I call as plan A. Good company, good promoter.
Yes. Yes.
Then you build a second layer of protection by saying that I will amortize quickly, I'll keep the tenor short, collect coupons,
Yes.
reduce my exposure during the tenor.
Right.
Third is collateral.
Yes.
So this happens at the deal level, collateral, governance, protection.
Yes. Yes. Like
After
any
this-
lending.
Yeah, like any other lending.
Yes.
What people forget at some point of time is these are high-cost borrowings. Things can go wrong. These are middle market landscape.
Yes.
Keep the position size small.
Yes.
Keep it under 5 to 7. Do more deals. Do shorter tenor deals. Create a portfolio which is a very different
Diversify.
characteristic
Diversification.
when it comes to a.
And not concentrating
But
on
this
one
strategy,
client can be one.
Nisha,
Yeah.
this strategy is not replicatable to a distressed desk. It's not replicable to other classes of strategy, and it could be variant to
Yes.
Amit's thinking. It could be variant to the way Piyush thinks. This is how we think in performing credit.
But I think I would like to add, since you said about exit, I think what has been heartening in India is that private credit space has seen significant exits.
Yes.
All the people here who are sitting have seen good exits in the portfolio.
Yes.
I can give out our numbers broadly. We invested 21,000 crores over the last 5 years.
Yes.
And our cash realizations are more than 23,000 crores. So I think what IBC has done has brought in about a credit culture.
Yes.
Where the promoters do not want to lose their companies.
Yes.
And that is also fanning some amount of interest from the offshore investors
Yes.
into the country. Because prior to 5 years, today private credit deploys, in my view, anywhere between 30 to 35,000 crore annually. This number was not even 3,000 crore 6-7 years back on an annual basis. So I think we have come a long way, and we have a way to go.
Yes.
But I think we are on the right path. That's
All
what I
right.
think.
That's right. So Piyush, of course, you can comment on this aspect as well. But I want to understand, being an AIF product under SEBI's regulation, AIFs have also gone through their whole, evolution of regulatory changes. How are we stacked up now, and how have changes really impacted the course of this particular space?
So look, on the regulatory side, I would say we are still evolving. It is still, the AIF industry in India is still in formative years compared to what it is in the developed markets.
Yes.
And I think over the particularly last 15 months or so, there's a lot of wood that the regulators have been chopping in terms of putting in a very comprehensive framework, a lot of housekeeping issues being fixed, etc., to ultimately lay a strong foundation for this asset class to really grow. So I think, be it compliance obligations, related party transactions, certification of an investment team, dematerialization of units, valuation, there are various areas in which
Yes.
SEBI has been coming out with a lot of regulatory fine-tuning,
Yes.
and which is all in the direction of making it more robust framework.
Right.
Having said that, I think there are some areas where it's under regulatory consideration, and I
Right.
think in the months to come we expect clarity, and that would definitely be the new enablers.
All right. So regulations are still evolving. That's one thing to watch out
But
for.
Nisha,
Finally, 30 seconds, Kapil. How do you see this now growing, and also lessons from the past? Because some of the investors have burned their fingers in the past, and there are several lessons.
First thing we must understand, Nisha, is that the crop of current asset managers which are there today are all coming out of very good pedigree, track
Yes.
record. They are not sitting in levered vehicles. They don't have compulsions.
Yes.
Their carry compensation is aligned to the outcomes of the fund.
Yes.
It's a very different ecosystem
Yes.
than compared to what happened in the past.
Right.
Nisha, people don't understand this. What happened in the past happened in the books of a levered and a rated NBFC, where compulsions of doing a certain things are very different.
Yes.
Tell me one credit fund which has gone wrong, other than real estate as a category, which has gone wrong, which was in the AIF format.
Right.
So there's a lot of
I take your point over there.
alignment happening,
Yes.
because what went wrong was in an NBFC format, which was levered, rated, and regulated.
As long as we learn from
lot
the
of
past,
lessons
but
have
it's
been
a
learned.
differentiated product, and one of the key aspects in lending for the growth capital for the companies, and is set to grow, and therefore the demand coming in, and also the investor interest
And
coming
by the
in.
way, it's an
Yes.
other important figure from the regulatory aspect. He covered everything. There were 8 consulting papers that came out from February to May. 8 consulting papers by SEBI.
Right.
So SEBI is in overdrive, and all of us, we are very happy with the way regulations are shaping up.
All right.
So it's not, we have miles to go. We have already covered a lot of ground as far as
All right,
regulations
so
are
the
concerned.
space evolving, and it's getting bigger, and it's
getting
important
regulated.
to keep an eye on it.
Yeah,
Thank you so
getting-
much, Kapil, Amit, as well as Piyush,
Thank you.
for this very interesting discussion. With that, it's a wrap on this edition of Big Deal. Keep it with CNBC TV 18.